The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon and a warm welcome to all. I am Ridil Mishra and on behalf of Care Ratings welcome you to a live webinar on Indian steel industry who will see the sunshine. Care Ratings sincerely appreciate your time in joining us for this webinar. To take you further on this, may I introduce our speakers for today. We have with us Mr. Sanjay Agarwal, Senior Director at Care Ratings Limited. Mr. Sanjay has over 23 years of experience in the field of ratings, banking, and infrastructure finance. Prior to joining Care Ratings, Mr. Agarwal has worked in ICICI Bank and IFCI. Our second speaker for today is Sharmila Jain, Associate Director at Care Ratings. Sharmila has an industry experience of over 11 years in rating operations. Our third speaker for today is Mr. Hitesh Avachat. Hitesh has over 11 years of experience in research and rating operations. I would like to inform a participant that the discussion will be in form of a presentation which is visible on your screen. In case of queries, please key in your questions in the slot provided. Our speakers will take the Q&A session at the end of the presentation. I repeat, in case of queries, please key in your questions in the slot provided. We'll be having a Q&A session at the end of the presentation. Now may I request Mr. Sanjay to begin the session.
Thanks, Mridul. Good afternoon, everybody. Friends, the steel industry globally and in India has seen substantial volatility in the recent few years. However, with government support, which was almost immediately followed by improvement in global conditions, the industry is now on a rebound. Utilization efficiency of Indian steel sector is much better than China and global averages, despite China, which dominates the global steel market, now showing better data points. Interestingly, while a large part of the domestic capacity is suffering from financial distress, the operating performance of these companies seems to be satisfactory, with a very high level of capacity utilization for the industry as a whole. Currently, limited capacity addition is underway. For capacities under financial distress, once the distress is resolved, they may be able to add some limited capacity with debottlenecking and low-hanging brownfield projects. Beyond that, serious efforts have to be made to increase fresh capacity addition to take care of incremental domestic demand. At 65 kgs per capita and 37 kgs per $1,000 of GDP, the domestic consumption and production are low compared to China figure of 514 kgs per capita and 63 kg per $1,000 of GDP. Apparently, underinvestment in infrastructure has led to skew in the consumption profile. However, improvement in consumption would also depend on government and private sector capex, which will have to be monitored as we go ahead. With this backdrop, my team will take you through the various updates on the industry, how will the industry span out in the next 2 years, as well as various credit rating aspects. Over to you, Hitesh.
Thank you, Sanjay. We'll start with the global markets first. As can be seen from the first slide, decadally, usage of steel has only been increasing. As we all know, amongst metal, steel stands first, followed by aluminum and then copper. Although steel can be and is substituted, it continues to be the favorite because steel is comparatively cheaper than other metals. Its increasing usage in alloy form is finding newer applications, especially in the industrial area. The table below the graph depicts the decadal CAGR growth in global steel production and consumption, which have been in line except in the 2000-2010 decade. In this decade, the CAGR of steel production has surpassed the steel consumption. If we analyze the year-on-year number for this decade, then in 5 out of 10 years, the production has been higher than consumption. Having said that, in the last 5 of the 7 years, the steel consumption has increased at a faster pace than the production growth, thereby somewhat reducing the inventory overhang in this sector. In the next slide, we will see how the global steel industry has increased. The capacity has increased phenomenally. Despite all odds, the global capacity continues to increase. During the last decade, while the capacity growth has increased at a CAGR of about 4.5%, the growth in production has remained lower at around 2.5%. This clearly indicates a decline in global operating rate from around 85% in 2006 to around 70% in 2016. So now let's look at the difference between CAGR of capacity, production and consumption to understand the real improvement in the global demand supply situation. Capacity has grown at a much higher rates post CY 2008. This is mainly because most of these capacity were already under construction and they continued to get commissioned over a period of time. So what is the real situation on the ground? Despite of the declining margins and slowing demand growth, globally steel industry continues to add capacity. These capacities are coming up in countries like India, China and other Asian economies, especially in the Middle East. CARE expects another 100 million tons of net addition in global steel capacity during the next 2 to 3 years, while consumption during the same period is likely to increase only by about 48 million tons, which means on an incremental basis, the utilization rates are likely to soften marginally during the next 2 to 3 years. The chart also depicts the additional available capacity of the industry, which has shown an increasing trend even after 2011 right up to 2016. We believe that this capacity is likely to moderate going ahead. Currently, at a utilization of around 85%, globally, overcapacity is around 14% of the existing capacity, which over the period next 2 to 3 years is likely to improve to around 9%, mainly on account of capacity shutdown of some of the major players which are in the last quartile of the steel industry cost curve. Over the period under consideration, that is 2000 to 2016, the annual production volume of crude steel has remained higher than the consumption level in most of the years, indicating a surplus situation in the global steel industry. Demand-supply mismatch has in fact shown an increasing trend from just a surplus of around 3 to 4 million tons in 2000 to around 25 million tons in 2010, on account of the faster growth in global steel capacity than the growth in consumption. The global consumption of the crude steel has increased at a CAGR of around 2.7% during the last 10 years, that is 2006 to 2016, while the capacity has grown comparatively at around 4.5%. Post the financial crisis, the demand has been dependent on the stimulus packages announced by various governments across the world and the rebuilding measures of the policymakers for supporting the growth. The improvement in inventory position is not because of an improvement in demand, neither on account of slowdown in addition of steel capacity. This is mainly on account of a decline in global operating rates. Let us move at the region-wise analysis of steel. We are considering three major economies, which is China, USA and India, to understand how the steel demand is moving in these three regions. Now let's look at which are the main end user sectors for steel. The slide depicts the end use consumption pattern for steel globally, in China and in India. As can be seen, albeit with varying percentages, construction, auto and capital goods sectors account for almost 70% of the end use consumption pattern of steel. Hence, let us understand what is really happening in these sectors in the major steel markets to understand what will drive the demand for steel in future. So let's start with China first. Last few years have seen the Chinese GDP growth decelerating from a high of about 10.5% in 2010 to around 6.5% in 2016. The graphs above indicate the slowing trend of the Chinese construction and the capital goods sectors, the main consuming sectors for steel. CARE believes that the role of the Chinese government through its various stimulus packages has been an important supportive factor for the growth to be sustained at these levels in the past 2 years, with participation of private players continuing to remaining low or reducing. According to various estimates, Chinese GDP is likely to grow at about 7% in the next 2 to 3 years. The better than expected improvement in the European and the US markets, on which China's export market is highly dependent, has shown some signs of stabilization. Also, in the domestic market, there are signs of improvement, especially in the construction space, with year on year growth in value added construction sector gaining some momentum. However, it is clearly evident that the Chinese steel industry has shifted gears from a robust growth driven by the exports markets to an era of a more stable domestic consumption driven model. Now let's see what is happening in the US and in the construction sector. Here we are referring mainly to the household sector. As we can see from the graph, the year-on-year addition in houses built and completed have been improving, and so is the improvement in the under construction activity. The ratio of under construction houses to completed houses has by far peaked in the last 2 years at around 95%, signifying a robust growth in demand for steel from the housing and the construction sector. The automobile production has also witnessed a shift in its production base over the last 15 years. While China has been the dominant force during 2000-2010 period, followed by India, the last 6 years indicate that the US automobile production has made a healthy recovery. The US automobile industry accounts for a share of around 20% of the end-use consumption pattern of steel in the US. As can be seen in the earlier two slides, the growth in steel demand for the US markets will continue to remain on the back of improvement in the household construction sector along with the improvement in the automobile production growth. The chart indicates the global automotive production growth and the CAGR growth of a period from 2000 to 2016 and further breakdown of a CAGR period between 2010 and 2016 and the changes happen in the various economies. Let's move at the Chinese steel industry now. This graph indicates the current state of the Chinese steel industry. While the capacity has increased from around 530 million ton to around 1060 million tons in the past decade, that is around 2006 to 2016, consumption has increased only from 390 million ton to around 710 million tons, indicating excess capacity in the Chinese steel industry. Going ahead, CARE Ratings expects Chinese steel consumption growth to remain moderate, thereby keeping inventory levels elevated for an extended period of a time. Some of this inventory may find its way to the Asian markets. While the Chinese domestic demand is likely to be supported from the domestic demand, demand from exports market will continue to remain under pressure on account of various anti-dumping duties levied against Chinese steel producers. This chart indicates the current state of the US steel industry. In comparison to China and other Asian economies, we have seen that the US demand for steel has seen a significant improvement. While Care Ratings expects no capacity addition in the US steel industry, the US demand is seen improving over the next 2 years on the back of increasing production activity from the automobile manufacturers as well as growth in the housing construction sector. We believe a marginal improvement in the capacity utilization rates for the US steel industry during the next 2 to 3 years. This chart is just a continuation to our previous slide of shifting powers in terms of shifting share of the global steel consumption pattern. While the European share in the global steel consumption has declined from around 22% to just to around 11%, same which is in line with the United States, which has declined from around 11% to 6%. The only two gainers remain is China, which has grown from around 18% to around 44%, and India, which has grown from around 3% to around 6%. The key note to be here understood is while China has been growing in the last 3 years, we see that the Chinese consumption share has in fact dropped from around 46% to around 44% in the last 3 years, that is from 2013 to 2016, while in the European market, we had seen a percentage growth from around 10% in 2015 to around 11% in 2016. So how is the steel consumption moving in line with the global GDP growth? This chart depicts that the beta of steel is higher than the real GDP growth. So in a downturn, steel demands falls more than proportionately, and in an upswing, it bounces back higher. What we see is actually a catch up of the real GDP growth as far as the steel consumption is concerned, which is likely to move up over the next 2 to 3 years. Going ahead, Care Ratings believe that the global supply is likely to adjust itself with the growth in global demand. The major players across the globes will have to play a crucial role in balancing the industry's demand supply situation, more so over the smaller fragmented players within the industry. CARE believes that the global surplus position is likely to decline in the next few years on account of a shutdown or partial closure of those capacities which are lying in the last quartile of the global cost curve. The answer to the increasing cost of manufacture lies in the dependence of imported coking coal and iron ore. Currently, coking coal prices are hovering around $130 per ton, while iron ore prices are around 75 to $80 per ton. But these have come off from a high of around $300 per ton, as in the case of coking coal. Coke prices have come down presently to around $225 per ton after witnessing levels of around $350 to $400 per ton. CARE believe the prices of coking coal and coke will continue to remain the key sensitivity for the profitability of the global steel industry in comparison to the iron ore prices or the movement in iron ore prices. We'll shift our focus now to the India story and what is happening in the domestic market. This slide is just to showcase the viewers the end-use consumption pattern of the Indian steel industry, which is bifurcated into long steel and the flat steel. In the past decade, domestic steel consumption has grown at a CAGR of around 10% as against a global average of around 5% and a China growth of around 16%. In line with domestic steel consumption, domestic steel capacity has only shown a remarkable addition. The capacity utilization of the industry has hovered at around 85%, which is considerably higher than the global average of around 70 to 75% in the past few years. Despite significant capacity addition during the last few years, India continues to remain a net importer of steel until FY16. The red bar shows the volume of net imports in the country. Only in the year FY17 have we seen that the exports have increased much more than what the Indian steel market has imported. So, what will be the path ahead for the Indian steel industry? The Indian steel industry is much more favorable placed than others of its kind in withstanding the global pressures. Despite of the hindrances, we expect that the Indian steel demand to grow at a modest pace of about 5.5% during the next 2 to 3 years. We expect a steel capacity addition of another 16 to 20 million tons during the next 3 to 4 years, while the incremental demand is expected to be in the same range. We expect capacity utilization of the Indian steel industry will continue to hover around 85% in the next 3 to 4 years. Consolidation in the sector is likely to pick up. We are just showing the consolidated picture. Currently, in the Indian steel industry, there are four players each with a capacity about 10 million tons and 5 million tons respectively. We believe these numbers will also decline too in a similar in terms of emergence of a couple of players with a steel capacity of about 20 million tons in the next few years. There will be consolidation even among the smaller players to become more competitive in an industry which is increasing its minimum economic size over the years. With this, I will now hand over to Sharmila to speak about the credit rating aspects related to the Indian steel sector. Over to you, Sharmila.
Thanks, Hitesh. This slide covers the certain key features which are specific to the sector. First is about cyclicality. Steel is a cyclical industry and is strongly correlated to economic cycles since its key users, namely automobiles, construction, and consumer durables, are heavily dependent on the condition of the economy. Apart from the cyclicality of the end user industries, heavy capital investment and a gestation period of 2 to 3 years for a new plant also contribute to the cyclicality of steel prices. Second is continuous production process. Steel manufacturing is a continuous process and therefore steady supply of raw materials is very crucial. Next is working capital intensiveness. Manufacture of steel is a working capital intensive process with the production cycle at around 50 days. Long working capital cycle is mainly on account of high inventory maintained by the manufacturers, both in terms of raw materials as well as finished goods, and also because of the standardized nature of the finished products as well as geographically limited spread out regarding the supply of materials. Next is ability to pass on input cost to customers. In a normal market scenario, the manufacturers of steel are able to pass on the increase in cost of raw material to consumers as steel is important to the various economic activities. Next is entry barriers. The capital intensive nature of the steel industry coupled with the long gestation period acts as an entry barrier to small entrants. However, in India, a number of players have set up induction furnaces which need less investment. However, these induction furnaces produce very low quality and quantity of steel. Next key feature is about the availability of finance. The steel industry is both fixed capital as well as working capital intensive. Thus, availability of finance for both expansion as well as running day-to-day operations is critical. The raw material suppliers tend to dictate the payment terms as there is heavy dependence on the supply of raw materials. Next, I'll be speaking about the rating methodology of steel companies. For rating the companies in the steel sector, CARE Ratings follows the standard rating methodology belonging to the manufacturing sector, which involves evaluation of the industry in which the company operates, assessment of the business risk factors specific to the company, assessment of the financial and project related risk factors, as well as the quality of the management. Apart from these, there are certain additional factors that are considered while arriving at the rating of companies operating in the steel sector. First is control over supply and cost of raw materials. As mentioned earlier, uninterrupted supply of raw materials is very important for the continuous production process. CARE considers companies who have control over supply of their raw materials as more capable of being cost efficient. Raw material constitutes around 70 to 75% of cost of sales of steel. Further, due to limited global availability of key raw materials like iron ore and coal, the raw material industry is supplier dominated. Ability to control raw material costs is therefore a key determinant of profitability. Although most steel manufacturers are able to pass on the increases in raw material prices to their customers, generally the profitability of companies who have control over their raw material costs would be higher. Also, companies whose plants are close to the sources of raw materials or who are located near to the ports have an advantage in terms of freight cost. Another important cost is power cost. Steel manufacturers who are able to utilize captively generated fuel sources are viewed favorably as their power generation costs are likely to be lower. Next parameter is the technology used. The technology used for manufacture of steel determines not only the quality of steel produced but also the cost of production. CARE views use of sophisticated and proven technology as a rating strength. Next feature is geographical and product diversification. Steel companies with a diversified market base can take advantage of regional demand supply mismatches, which will help mitigate their market risk. Geographical diversification also mitigates political and economic risk. Steel manufacturers who have progressed up the value chain by diversifying to value added products while continuing to manufacture crude and intermediary products are considered favorably. Next important point is debt when compared to the capacity. Total debt when compared to the capacity is analyzed. Moderate debt levels provide financial flexibility to the companies when there is a downturn in the industry. Next is working capital management. Due to the long working capital cycle of the steel industry, CARE Ratings believes efficient working capital management to be an important rating factor for the steel manufacturers. And the last factor specific to the steel sector is size. Size of the company is a significant rating factor for a steel company as the industry is fixed capital intensive. Companies with a large capital base are considered better able to withstand downturn than others due to the stronger negotiation powers, their larger reserves, and therefore they have greater financial flexibility. This slide mentions the dispersion of CARE ratings rated clients. Currently, there are 351 companies rated in the steel sector by CARE ratings. Out of this, 221 companies are in sub-investment grade, that is 63%. And within investment grade also, majority of them are rated in the BBB category. And within AA category, there are 8 companies. Some examples under the 3 investment rating bands are given in this slide. This slide talks about the rating movements, that is upgrades, downgrades and retentions during FY17 as well as H1 FY18. Majority of the ratings during these periods have been retained and most of the revision in the ratings was on account of industry related factors. During FY16, there were many downgrades based on the industry slowdown, and these downgrades continued in the first half of FY17 as well. However, with the improvement in the industry scenario, many companies have been upgraded in FY17 and H1 FY18. These are the key ratios analyzed while rating the steel sector companies. EBITDA per ton, net debt to EBITDA, overall gearing, which is total debt over tangible net worth, interest coverage, which is EBITDA over interest, as well as total debt over gross cash accruals. In this slide, we have given key ratios of the industry. Here, top 4 players in terms of domestic capacity have been considered and the 4 key ratios have been calculated here. The players considered are Tata Steel with 13 MT of domestic capacity, JSW Steel with 18 metric tons of capacity, SAIL with 14.7 metric tons, and SR Steel with 10 metric ton are considered. Also note that while calculating EBITDA per ton, standalone figures of Tata Steel are considered, and for the other 3 ratios, consolidated figures of Tata Steel are considered. Whereas in case of the other 3 entities, standalone figures have been calculated for all the 4 ratios. We see that all the ratios have deteriorated during FY16. During FY17, 3 ratios, that is EBITDA per ton, net debt to EBITDA, and the interest coverage have improved when compared to FY16 levels. However, overall gearing ratio has deteriorated further as on March 31, 2017, mainly on account of both increase in the debt as well as decline in net worth in case of SAIL and SR Steel. With this, I hand over to Sanjay for the concluding remarks.
Thank you, Sharmila. To sum up, the global steel industry is expected to remain firm on account of improvement in demand. This is despite the prevailing overcapacity situation. Data from China will have to be monitored on a very regular basis. As far as Indian steel sector is concerned, demand is improving at a lower pace. Prices are expected to remain firm on the basis of global factors and support from government. Also, further consolidation is expected for the smaller players to remain competitive in the market. Care Rating expects the credit profile of Indian steel players to continue to remain largely stable. With this, I thank you all. Now I request Mridul to take forward the proceedings of this webinar. Thank you.
Thank you, Mr. Sanjay, Hitesh, and Sharmila. Dear participants, now we will be taking a break of 2 minutes before we come back to take your queries. You are requested to please start keying in your questions in the slot provided. I repeat, we'll be taking a break of 2 minutes and before we begin our Q&A session. Hi friends, we'll begin our Q&A session now. The first query is from the line of Mr. Suresh Chellai. He's asking how long do you expect the Indian government to continue with this protectionist outlook which has benefited the Indian steel companies?
Hi Suresh. If you look at the current scenario post the anti-dumping duties, there has been a MIP for steel imports in India. Now this MIP is for a period of 5 years, which has been stated by the government upfront. So as of now, and this is just the first year, which is of the 5 years MIP which the Indian steel players are enjoying. So we see a continuation of this MIP in the next. There will be no change as such in the government stand with respect to the MIP, because what has happened is not just India but globally as well, whether it is the European government or whether it is the US governments, they have slapped various anti-dumping duties on certain grades of steel from the Asian market, which also include China as well as India. So we see that most of these government will actually try to have a protectionist outlook over the domestic steel industry, and we see the continuation happening going ahead as well. There is a question from Harshad Deshpande. What is our view on global HRC prices, coking coal prices, and the global iron ore prices for CY18? Harshit, currently the world export prices for HRC are hovering around 520 to $560 per ton, and we don't see any further change as far as CY18 is concerned in this price numbers. What we have seen is there has been an improvement in coking coal as well as iron ore prices. But if you look at coking coal over the last 12 months, the much hype of the price has actually gone down, and now the coking coal prices are hovering at around 116 $120, or at best $130 per ton. So we don't see any further improvement in coking coal prices. Having said that, any disruption, especially on the coking coal exports from Australia, would actually take the prices anywhere. But otherwise, steel prices would be hovering around 550 $560 per ton, whereas iron ore would be around 70 to $80, and coking coal would be around $130 per ton. There is one more question on the view on iron ore prices, the domestic iron ore prices after Supreme Court ruling on illegal mining. Uh, See, while there has been a Supreme Court ruling on the illegal mining, if you look at the recent Supreme Court view on the allowing of increase of output from the category B and category C iron ore mines, especially in Karnataka, what we see is basically a steady flow of iron ore for most of the Indian steel capacity. So there was a time when this Supreme Court ban had happened, that India was actually importing certain grades of iron ore, especially the lump ore, from the Indonesian and the Australian market. However, now this has been taken over by the domestic players. So in the domestic markets, if you look at the iron ore prices, they will remain at the same level in the next 2 years. We don't see a significant drop or increase in prices. Yes, there is an improvement in supply of iron ore, but so is an improvement in the manufacturing of pellet activities as well as the Indian steel production, which is around 100 million ton now. So whatever we are producing excess post the mining ban, we are actually consuming it internally. The excess incremental supply is taken care of.
There's another query from Mr. Suresh Chele. Is asking, are there new capacities coming up in India? Which companies are investing in these capacities?
Although most of the players are looking at acquiring the capacities, we can see that there will be some capacity addition by JSW because they can expand their capacity at the existing unit itself in Vijayanagar, also Dolvi, and also Tata Steel is looking at expanding its capacity. However, we see that there will not be any major capacity addition. These will be only small capacity additions. And otherwise, most of the players are looking at buying the existing available capacities.
To further add on to the capacity question, what we see is basically an addition of around 18 million tons in the next 2 to 3 years. This is the capacity which is already announced. So whether it is by SAIL or whether it is by Tata Steel, these capacity is already announced. However, it will come up in phases in the next 3 to 4 years. Uh, there is one more question on the coking coal prices, how the prices are determined in the domestic and the international market. So, as far as the coking coal prices are concerned, whether it is India or whether it is China, most of the coking coal is imported. It is imported from Australia, largely imported from Australia. So, while deriving at the prices for coking coal, uh, globally, it is seen the contract prices between the Australian and the Japanese steel manufacturers, as well as the contract prices between the Chinese and the Australian uh, Chinese steel manufacturer and Australia with respect to coking coal. Manoj, there is a question from Mr. Manoj Shah on what is the kind of average EBITDA per ton expected in 1819 for the top four players in India. Uh, we would not like to mention about the top four players, but we expect that the average EBITDA per ton for the Indian steel industry would be around 7,500 to 8,000 rupees per ton. So this will also include large as well as integrated players as well as the secondary players. There is a question from Anurag Shah. How do you steal the stress assets in steel being taken over by existing healthy companies, impacting the production levels by SR Bhushan in electro steel and thereby overall supply of steel in Indian markets and prices thereof? Uh, Anurag, as far as the Indian steel capacity utilization is concerned, even at the current situation, India is operating at a rate of around 83 to 84% of the capacity utilization rate. This means that even some of these stressed assets are producing certain grade of steel or certain amount of steel currently. So there will be further addition in supply of the metal in the domestic market, with most of these stressed assets actually improving upon their operating rates. However, having said that, what we see is also a improvement in the overall demand outlook for the domestic steel industry. So in the last 2 years, it has just grown at around 2 to 3%. Now we are seeing that the consumption would be increasing at around 4 to 4.5 to 5.5%. So yes, there will be some improvement, and this additional production will be actually absorbed internally. About the prices, Indian steel markets, yes, the prices will be determined more so by the major integrated steel players. So there will be some pressure for the secondary steel players in terms of when these large players actually operate on a higher or utilization. What we'll see is some of the secondary steel players will actually be facing certain pressure in terms of the margins, but not alarmingly, not to a extent which we see as alarming.
The next query is from the line of Krunal. He's asking which company would be better for long-term investment purpose and why.
Krunal, as far as I mean, from investment point of view is considered, see, we have highly rated companies in the steel sector which are in AA category. So those kind of companies, there'll be very less probability of default, and also they are fundamentally strong in terms of most of the parameters, because they'll be having integrated nature of operations, and in terms of debt levels, they will have moderate kind of debt levels, and they will be able to withstand even the industry downturn. So based on these factors which are fundamentally strong, I mean, you can look at better rated companies in the sector.
Uh, there's a question from Bhavya Shah: which countries or continents to which India is an exporter? India is currently exporting a large grade of steel to some of the Middle East players as well as to the African countries. Also, there are certain grades of steel, for example, stainless or alloy steel, or even the pipes which are being exported to markets like USA as well as in Europe. Yes, but these are very certain grades of steel, and not 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 a significantly higher number. There are certain integrated players which are in fact exporting a lot of steel to the extent of around 2 to 3 million ton as well in a single year. There is a question from Zain Iqbal: are anti-dumping duties import in Europe for Chinese steel? I have heard that Europe imports 24% steel from China. If Europe imposes anti-dumping duty on Chinese steel, then what is your view on steel and coke prices? Well, yeah, Zen, actually, if you look at the overall European steel market, or even if you look at the US steel market, they both are a net importer of steel. And this has been happening over the last decade or so. When we refer to exports of or anti-dumping duty, there are certain specific grades of steel which are hampering the domestic steel market in Europe or in USA, which are being taken care of, and also certain grades of steel which is of a low quality steel, which predominantly contains a higher level of sulfur or phosphorus, which are not considered as a good steel as far as the European markets are concerned. That grade of steel continues. There are certain levies which have been put by Europe as well as the US market as far as China is concerned. What is your view on steel and coke prices? Well, if you look at the current scenario, globally there has been an improvement. Uh, China is showing substantial improvement. However, if you look at the numbers which are published by International Iron and Steel Institution, they have clearly mentioned this is also on account of the renumbering which has happened in the Chinese steel industry. So we need to look at those numbers in line with what ISI is telling us. As far as the prices are concerned, globally coke prices have stabilized. So we see that the coke prices would be hovering around at the same level. As far as the steel prices are concerned, they would be hovering around 550 $560 per ton. This is HRC export prices, especially in the Asian markets, which are the indicators of global steel prices. There's a question from Manoj Shah. With electric vehicles coming in few years down the line, do you think the quality or grade of steel required for these vehicles will be different? Who are the Indian players currently producing these grades of steel? Manoj, w- as far as the electric vehicles are concerned, you are very much right. What we see, there is a substantially different grades of steels which has been used as far as electric car manufacturing are considered. This is majorly the alloy steel which is being used so that the weight of the vehicle remains low. Uh, Currently, does India has that capacity to produce certain grades of alloy steel? Well, most of the Indian steel players, even if you look at the top three Indian steel players, they have actually collaborations with global players, whether it is Nikkor or the JFE or whether it is ArcelorMittal, in terms of the technological tie-up to manufacture such kind of steel. So yes, going ahead, even if anybody want to actually set up an electric vehicle plant in India, there will be this alloy grade steel which can be manufactured in India, with most of the major steel players actually taking up the steps in collaboration with their foreign technicals.
I think that was the last question answered because there are no more questions coming. Thank you very much to all participants for taking the time out and being a part of this Care Ratings webinar. We hope the discussion was insightful and look forward to your participation in future also. For any feedback, suggestions, queries, you are most welcome to write to us at cop.com at careratings.com. The feedback email would be individually coming across to you by email. Thank you so much and goodbye for now.